Good evening and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and today we're here to talk about a topic that is very near and dear to my heart, which is technical analysis, and more importantly, how you can leverage technical analysis with your options trading. Technical analysis, from my perspective, is very important for options traders because whenever you're trading options, timing is extremely sensitive, and technical analysis is a tool that you can utilize to help you better time your specific trades, even if the trade thesis that you have or the underlying theme of your trade is based on other factors like fundamentals or news or anything along those lines outside of the charts. Technical analysis is still very useful in helping you time your trades. But there are many limitations to technical analysis, and that's part of why we're here to discuss this today, is to really understand the different forms of technical analysis, what they're used for, what are the limitations of each one, because that will help you determine how to select the optimal option strategy for different outlooks that you have on the underlying stock based on technical analysis. So those are the things we want to go over with you here today. My name is Tony Zhang. And before we start here, what we're going to discuss here today is purely for educational and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So for those of you that already have access to OptionsPlay, you have access to the platform that will show you technical analysis and, more importantly, how to leverage option strategies off of them. But if you're brand new to OptionsPlay, if you have not already signed up for a free account, this is all courtesy of the NASDAQ exchange. You can sign up for free using the link on your screen, which I just posted into the chat window. That will give you access to the full OptionsPlay Nordics platform. It'll give you access to bi-weekly options educational webinars like the one that we're on right now, and access to a free on-demand video library so that you can take all of the previously recorded webinars, watch them at your own pace to learn more about options trading here in the Nordics. And for those of you that sell cover calls or short puts, you have weekly reports that are emailed to you so that you find these opportunities to leverage these strategies for your portfolio. Again, all of this is courtesy of the NASDAQ exchange, and you can sign up using optionsplay.se. So we're going to go over quite a bit here today. So I'm going to go through quite a bit, but before I get started here, if everyone could bring up the chat window, which is at the bottom of your screen. If you could just please type yes into the chat window if you currently utilize technical analysis in some way, shape, or form in your trading. And please type no if you do not use technical analysis, if you do not use the charts for your trading here. Okay, so it seems like pretty much everyone here has answered yes. I see one no. So for those of you that answered no, if technical analysis is new to you, I will show you what I think is a great resource to help you get started with technical analysis. And even for those of you that trade using technical analysis, I think that the chart school available at stockcharts.com is one of the best places to go to learn more about technical analysis. So what I will do is I will chart school. I will give everyone the link here to this particular page. Very useful resource in my opinion if you're looking to learn more about technical analysis. So today what I'm going to do is I'm going to talk to you through, number one, what is the value of technical analysis to a trader like myself? How do I leverage this form of analysis when I'm either trading for myself or if I'm advising clients, whether it's institutional or retail, helping them better understand what's currently going on with the markets. I always leverage technical analysis to do so. So I want to show you what the value of technical analysis is for me, and then what option strategies do you want to utilize for technical analysis. Once we go through the different forms of option strategies, when you should use certain strategies, when should you avoid certain strategies, then we'll talk about different forms of technical analysis. Now, today, what we're going to be able to do is just scratch the tip of the iceberg. We're not going to be able to go through all the different forms of technical analysis, but I am going to cover the main broad strokes of technical analysis. That's price analysis and patterns, chart overlays, momentum indicators, leading and lagging indicators, and talk through how you should think about leveraging option strategies for each form of technical analysis, because each form of technical analysis has its pros and cons. And it's important to understand, again, what the limitations of each one, because that's really what you need to be able to select the optimal option strategy. So those are the things we're going to go over here today. A lot to cover, but I wanted to make sure that we went over that with you here today. So let's go ahead and get started. So I want to start off by talking a little bit about what the value of technical analysis. Why do I find this to be the most important metric, the most important form of analysis that I use when I'm trading the markets? Number one, just for a very textbook definition, if you will, of technical analysis, it's trying to forecast the future price or the future outlook of an underlying stock or asset based on the recent price history. So looking at history and using that as a template to understand what is likely going to happen in the future, keyword being likely. And this is really under the pretense that history may not repeat itself, but it certainly rhymes, meaning you can find patterns in what happens historically, take those patterns and apply them to what is likely going to happen in the future. But from my perspective, the most important part about technical analysis with respect to options trading is the fact that when you look at a chart, there are generally three things you can try to ascertain from that chart using technical analysis. Three things that are very, very important for options trading. Number one, that's direction. So arguably any form of analysis, whether you're doing fundamental, technical, statistical, whatever it is, generally speaking, will give you a sense for direction. Where is this asset going, higher or lower? The second thing that's important for options trading is magnitude, because you can't just say that I think a stock's going to go higher. You have to also determine, do I think it's going to go 1 point higher, 3 points higher, 10 points higher, 1,000 points higher? It depends on how far you think a stock can go to determine different types of things, like what strategy should you trade, what expiration, what strike price. Those are all important things. And lastly, timing. Because when you're trading options, you have an expiration date. You also have to get a sense for, if you think a stock's going to make a move, how much time is it going to take? And these are all things that you can get from technical analysis that you don't necessarily get from other forms of analysis. So from my perspective, when we're looking at a chart, it provides me with what I consider an objective view on price. And you can only get this objective view if you take the similar approach or the same type of approach day in and day out. If you use different approaches every single day, you're going to get a very different view. So this is really where the value of technical analysis comes into play, but you also have to use it in a specific way in order to get this type of benefit. But from my perspective, the biggest differentiator of technical analysis versus other forms of analysis comes from the two things. Number one, it's applicable to all instruments with a price. So once you learn how to read a chart and gain a directional view from that chart, you can apply that to any instrument, whether you're trading European equities, US equities, fixed income, commodities, currencies, regardless of what asset class you prefer to trade. You can utilize the same form of analysis across all the different asset classes. And the best part of all is the fact that we all trade different asset classes. We also trade on different time frames. Some of us have, a lot of time during the day and we can day trade all day long. Others have day jobs and you have very little time to trade during the day, so you are more a longer term investor. You can apply technical analysis to all time frames. You can do it on a few minute chart. You can do it on a monthly chart. You can do it on any time frame, which means that regardless of how often or how frequently you have time to trade, the analysis that you learn can be applied to any time frame. That, from my perspective, is the beauty of technical analysis. It's extremely flexible and is adaptable to all different types of environments. There are some limitations, though. Number one, I tend to get a lot of questions from users asking me, how should you use technical analysis? What indicators do I use? And I always tell users, I've been doing this for 14 years. And the one thing that I want to, I always want to drill into users' heads is, number one, no matter what type of analysis that you do, whether it's technical, fundamental, they only work in certain environments. No strategy works in all environments all the time. And it's important that you understand what your strategy is designed to do, understand when are the optimal environments, when it's not very optimal, because that allows you to, after a series of losing trades, which many times is when we tend to be reflective about our strategy, that's when we actually sit down and think about, are we pursuing the right strategy? Is our strategy still suitable? And being able to audit your trades after the fact allows you to get a better understanding as to whether the strategy is still one that you want to continue to follow. And the second thing is, there's no such thing as a best strategy or indicator. We have done a lot of back testing on the different strategies and the different indicators to see which parameters and which strategies give you higher returns, but the difference between the different indicators is fairly minimal. What's more important is how you apply the indicators, meaning applying the same indicators day in and day out has far better impact on your returns and your success as a trader rather than which indicator that you use. And that's something that I've observed over the last 14 years as a market strategist, seeing people utilize these types of tools in their trading. So it's so important to understand, the benefits, but also at the same time, the limitations. So with that, what I want to do is I want to talk a little bit about the option strategies that you would utilize for technical analysis, because many of us spend so much time on our charts, especially for those of you that are a bit more inclined to use technical analysis. We spend a lot of time on our charts, but the one thing that you want to remember is that the charts is not what generates profits. It's your trades that you make off of the charting that you do is what generates profits and what generates potential losses. So it's important that you understand that the trades that you're making are the most optimal for the outlook that you have. So what I have here is I've devised this screen down the middle. On the left-hand side, I have option strategies that are suitable when you have a clear sense for direction, which you always need whenever you're trading options, is a sense for whether you think the stock's going to go higher or lower. But there are many forms of technical analysis or different forms of analysis where you have a good sense of where you think the direction of the stock's going to go, but you don't have a very good sense for how far that move is going to be. So, and I'm going to go through different forms of technical analysis to when you might find yourself in this position, but there are plenty of cases where you're going to say, I'm pretty clear as to the direction, but I'm not clear as to how far the stock can go. Now, before I move on to that, I just want to make sure everyone understands that. Please type 1 into the chat window if that makes sense to you, where you believe that the stock's going to go in one direction, but you're not quite sure how far it's going to go. Right, okay, so I see a lot of ones. Now, this is, and we're gonna go through some examples of when that happens, but when this does happen, generally speaking, there are 2 forms of option strategies that are suitable for this. Number 1, buying straight calls and puts. That's for when you expect the directional move that you have is going to be very quick and very fast. So breakouts, and we're going to discuss some of those in a few minutes. When you expect the stock is going to break out in a specific direction pretty fast and pretty quick, you want to buy calls and puts. If you expect the stock to be more of a smaller neutral move, that's when you want to sell a credit spread. A credit spread will allow you to make a profit if the stock moves a fairly slow move in one direction, where you're clear about the direction, but you're not quite sure that it's going to move very much. And there are benefits to each one of these 2 strategies, but generally speaking, those are the 2 strategies that you would utilize in your trading when you have a strong directional view, but not a strong view as far as how far the stock's going to move. And then there's going to be other forms of technical analysis where you do have a clear sense for direction, and you also at the same time have a very clear sense for magnitude, meaning you have a clear target price and a direction that you think the stock's going to move in. For those types of trades, you're far better off buying what we call a debit spread. Now, if you're not familiar with credit spreads or you're not familiar with debit spreads, I do have whole webinars on these 2 strategies themselves. So you can always go back and review those webinars. They're on our education page. I highly recommend that you go and watch those videos if these are new option strategies to you. But But these are the two general categories you're going to find with technical analysis, where you have a clear sense for direction, but some of them you have clear sense for magnitude, other ones you don't. And it's important that you think about that when you're placing your options trade, because that's going to help you determine whether or not you are deploying your capital as efficiently as possible. So let's take a look at some of the major uses of technical analysis, and let's talk a little bit about how you should select your option strategies around them. So the first one we're going to talk about are support and resistance lines. This is what I would consider the purest form of technical analysis, which is observing the price of an underlying asset. Before we throw any indicators on it, before we think about moving averages or any of the momentum indicators, looking at price should always be the first place you look for clues as to what directional view the stock will have, because price is the only what we would consider leading indicator. Everything else is technically a lagging indicator because it's calculated off of historical price data. Price is the only thing that tells you in real time what's currently happening, and price many times gives you the template as far as what directional view that you might have. So the first order of chart analysis, or the first thing that you learn in chart analysis, is support or resistance lines. Support or resistance lines represent where buyers and sellers meet and where there's a shift in the equilibrium between buyers and sellers. And what I generally use for support or resistance lines are horizontal support or resistance lines. You can draw trend lines, you can draw channels that are on an angle, but I generally find that those are far more subjective. When you have a horizontal support or resistance line, it's very hard to be subjective, meaning it's pretty clear on these and the chart that I'm showing you that this stock trades within a particular range. And there's no one that could really argue that this 48 crown range is the ceiling for this particular stock, and the 40 crown floor here is a support line for this. When you draw a line horizontally, it's really difficult to argue, and I think it's very objective. When you start drawing trend lines on an angle, right, that's where it becomes a little subjective, so you can draw your lines different ways. So horizontal support and resistance lines, generally speaking, can be used in two ways. Number one, they can be used as reversal points, meaning I'm pretty clear that when it reaches $40, it's likely going to bounce higher. When it reaches $40, it's going to bounce higher. Or when it reaches 48, I'm pretty clear that it's going to reverse lower. When it reaches 48, it's going to reverse lower. Now, there's a few different ways that you can think about this. Number one, you can think of them simply as a reversal. So if you think of them simply as a reversal, meaning it's not going to go below 40 or it's not going to go above 48, then the best thing to do here is to sell a credit spread. A credit spread allows you to take advantage of the stock as long as it reverses. Whether it reverses a little bit, a lot, or a whole lot, it doesn't matter. A credit spread profits as long as the stock doesn't continue to moving lower. As long as it bounces higher, then you're profitable. The only time you lose money is if the stock drops significantly below your support level. That's one way to use it. That is the first way that most people think about support or resistance lines. The next one that you can utilize is if you have established a range like we have here, right? So I have a clear range between 40 and 48. What you can say is that, okay, it's now reached its support level. I think it's going to go all the way back up to its resistance level. It's reached down to the 40. I think it's going to reach 48 again. If that is the case, what does that mean? That means you do have a clear sense for direction, and you also have a clear sense for magnitude. Now, that generally only happens when you've established a trading range like the one that I've shown you here. Sometimes you just have some support levels where you don't really have a target price. So that's how you determine, should you sell a credit spread or should you buy a debit spread? It depends on whether you've established a trading range and you have a clear sense for how far the stock's going to go. Sometimes even within a range, maybe you like the fundamentals of the stock and you don't think it's going to go all the way down to 40. then you know that you're better off selling a credit spread. If you think that the fundamentals of the stocks are relatively poor and you think that there's a you have a fair amount of confidence that it will go all the way down to 40, then you should buy a debit spread. Does that make sense, everyone? Please type 2 into the chat window as to, the difference between these two different scenarios and when you should buy a debit spread and when you should consider selling a credit spread. Okay, perfect. I see a lot of 2s. Great. So now that we've talked about a trading range, let's talk about when a stock breaks out above that resistance level, right? So support or resistance levels are very useful when they're trading within a range, but sometimes they break out of that range, and that also gives us a nice signal for a continuation higher. So a clear sense for direction, but many times when we get a breakout, especially when a stock breaks out to new all-time highs, guess what? We don't have a clear sense for magnitude. Many times when a stock breaks out to new all-time highs, we have really no idea as far as whether it's going to break out a little bit, break out a whole lot, whether it's going to be quick or fast or slow. Hard to know. And that's generally speaking why whenever you get a breakout, there's only 2 strategies that you can do. You can either buy a call option because maybe this is the type of stock that has a lot of momentum and you're fairly certain that the stock can maybe make a quick and fast move. That's when you want to buy a call option. But if, let's say, this is the type of stock that doesn't make big and fast moves, maybe this is a blue chip stock, this is a high dividend paying stock, it's not a growth stock. So then what you might be is a bit more conservative and sell a put credit spread that basically will profit as long as the stock stays above this 87 level. It can go a little higher, a little lower. Even if it goes substantially higher, you'll make money, but it's not the most optimal strategy to use. But as long as it stays sideways here above 87, as long as it doesn't drop below 87, you can make money by selling a credit spread. Even if it just stays at 87, you'll still make money by selling that credit spread. So breakouts, it really just depends on the underlying stock. If it is a stock that is going to make a big move, buy calls. If it's not the stock that's going to make that type of big move, sell credit spreads. Now, the reverse is typically a little different. When a stock breaks below a support level, what you generally do have is some price history that you can go back to and say, well, when a stock breaks support, where is it likely going to find the next support? So many times when you get a breakdown, when a stock breaks below a support level, you have price history to look at that gives you a clear sense for direction. And sometimes you might even get a clear sense for magnitude. So this happened during the coronavirus sell-off, where because we have price history from last year and the year before, we can get a sense for how far the stocks, how far a stock can move to the downside. So that's where you can buy a put option if you expect the stock to make a big, fast move, as we did see during the coronavirus, and those types of sell-offs tend to be fast and violent. Or if it's more of a, during normal times, and you expect the stock to trade lower and you have a pretty clear price target, that's when you might want to use a debit spread. Okay, does that make sense, everyone? Please type 3 into the chat window if that makes sense to you, that when you get a breakout above a resistance or below a support, this is how you should think about, do I have a clear sense for how far it's going to move or how fast it's going to move, and then making sure that you apply the appropriate option strategy for that specific outlook. Now here I have a few different chart patterns. Chart patterns tend to get a little bit more subjective. It really depends on, who's looking at the chart, because 3 people looking at the same chart might have 3 very different patterns that they look at. So I don't put a whole lot of weight behind these types of patterns. They are useful sometimes, especially as continuation or reversal patterns. But the reason I'm putting this here is because many people do use this form of analysis to gain a sense for direction. So I just want to walk you through it to give you an idea as far as how to think about this. So the most common one that I probably see are double tops and double bottoms, right? So this is when a stock, reaches a resistance level maybe twice or maybe perhaps even 3 times, and you have this double top here, a triple top. And this, generally speaking, is used as a reversal pattern. Whenever it reaches that level, you believe that it's going to start moving lower. This is no different than what we just discussed before with support or resistance. And it's really important to remember that these have a clear sense for direction, but they don't necessarily have a clear sense sense for magnitude, because just because you have a double top, it doesn't necessarily mean that the stock's going to reverse 10% lower or 20% lower. It just tells you that it's going to reverse. It doesn't have any sense for magnitude. So that's why, generally speaking, when you have a double top or double bottom, you're much better off selling a credit spread, because the double top and double bottom in itself doesn't provide any sense for magnitude. Another popular reversal pattern is the head and shoulders pattern. This is when you have a similar type of double top, but it looks something like this, where you have a left shoulder, a right shoulder, and then you have a head. The difference between a head and shoulders pattern is the fact that you have a neckline with a clear sense for magnitude, because to enter a, I think the better way to draw this is probably something like this, because to enter a head and shoulders formation, you need to have a neckline, and you also have a projected move. So head and shoulder patterns is one of the few reversal patterns that gives you a clear sense for direction, and it also gives you a clear sense for magnitude, which means that when you do identify a head and shoulders reversal pattern, or maybe even an inverted head and shoulders pattern, these are generally better off using, in my opinion, debit spreads. Debit spreads, because you have a clear sense of direction and magnitude, will give you the best optimal use of your capital for a trade like this, because you're risking the smallest amount on a debit spread than any other strategy. And then you have, reversal patterns like cup and handle reversal patterns. This also gives you a clear sense for direction, clear sense for magnitude. And, like I said, this is by no means an exhaustive list of the different chart patterns that you can have, but this gives you, sort of a template to start thinking through, meaning when you're thinking through these types of patterns, when you're thinking, what is the right strategy for my outlook, ask yourself the question, do I have a clear sense of direction, and do I have a clear sense for magnitude? If the answer is both, to yes, debit spreads, long calls or puts are useful. If you have no sense for a magnitude, you want to sell credit spreads. And lastly, flags and pennants. This is when a stock makes a relatively big move and then consolidates for a while sideways and then continues its move higher. So this could be in all different types of shapes of flags and pennants, but basically it's a consolidation period after a big move, and then what you have is you project another big move to the upside. These, just like a head and shoulders pattern, have a measured move, and this gives you a sense for magnitude, so you can project the entry into the consolidation and then the exit. So when you have a clear sense for direction and you have a clear sense for magnitude, when these types of patterns, you're better off buying a debit spread. Okay, so like I said, this is just a small list. This is designed to give you a way of thinking about these types of patterns. There are hundreds of these patterns that you can identify. And again, they're far more subjective, so I don't spend too much time on it, but it gives you an idea as far as how to think about it. So if that makes sense to you, please type 4 into the chat window. Okay, perfect. So let's move on to some of the more popular indicators. I know many of you like to use these types of indicators. Moving averages, by far, probably one of the most popular indicators. If any of you use moving averages, feel free to type into the chat window which moving averages you use. The popular ones are the 20-day, the 50-day, the 200-day. I'm curious as to hear from users, if you use the 20-day, 20 exponential. Some of you like to use exponential, some of you like to use simple. The one thing I will say, we've done a lot of analysis on different moving average periods. And, the one surprising thing that we have found from technical analysis backtesting are that simple moving averages actually have better results than exponential moving averages, which many times is surprising, because many times we like to use exponential moving averages because they respond a little faster. But some of our research actually shows that simple moving averages provide better results for simple crossovers. So now, one thing that I want to point out is that moving averages being the most popular technical indicator that many people use, one thing that I don't think most people think through when they're using moving averages is that when you get a moving average crossover, when it moves below or above your moving average, Remember the fact that just because the stock moves above or below the moving average, what it does tell you, number one, is a clear sense for direction, but the moving average itself provides no insights into how big the move's going to be. So when the stock crosses below, let's say in this particular case, what I have on my screen is a 50-period moving average, there's nothing on this screen that tells me that the crossover below is going to result in a sizable move or a small move like here. The moving average crossover in itself doesn't tell you anything about the magnitude. It only tells you direction. And that's something that many times we don't really think through, whether or not we're truly getting a directional view from moving averages, because moving averages only give a sense for direction, no magnitude. Remember that, because the moving average crossover sometimes results in a big move, sometimes results in a very small move, right? These are both technically moving average crossovers, what you had back here and the signal that you had down here. The one up here lasted what looks like a few months versus the signal down here lasted what looks like 3 trading days. So remember, just because you get the crossover itself does not give you any sense for how long it's going to be and how much magnitude there's going to be. So generally speaking, we tend to find that selling credit spreads is the most optimal strategy to use on just the crossover itself. If, let's say, you have other forms of analysis on top of it, right? So maybe you have more of a fundamental view and you're using technical analysis simply as an entry point, then maybe you have a thesis to buy a long call or a put when you expect that the move is going to be fast and violent. And there are certain moving average setups that do lend itself more to being more fast and violent. Many times when you get a strong directional view, you get a crossover and then a continuation in the direction. So when you get a crossover and then a continuation in that direction, many times those tends to be more faster. But that's a more advanced use of moving averages. The most important thing that I want to remember and remind everyone is that when you're using a moving average crossover, it does not give you any sense for magnitude. So generally speaking, it's not the best strategy for options because options require a fairly good sense for magnitude and a fairly good sense for timing. So when you get a moving average crossover, you have no idea whether this trade is going to last 2 days, 2 weeks, 2 months, 2 years, so it's hard to pick an expiration date from that perspective. So those are some of the challenges when you're using moving averages with your options trading. That's not always obvious. So next time you see a moving average crossover, don't just go out there and buy a call or a put or a debit spread. Think about to yourself, what other views do I have on this stock? Does that help me understand whether I think this move is going to be very fast or slow? Because that's how you're going to determine the best optimal strategy for you. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. Okay, perfect. I see a lot of 5s. So the next thing I want to show you is Bollinger Bands. Bollinger Bands are still taking in the moving average, but they're using it in a different way. And many times what we see investors use Bollinger Bands as a retracement strategy, meaning every time it exceeds that upper or lower band, what you're expecting is a mean reversion back to the moving average. So when you're using these types of signals, that is one of the ways that you can use moving averages as a not only clear sense for direction, but also a clear sense for magnitude, because you're expecting a move from the upper band back to the mean or from the lower band back to the mean. So for these types of trades, because these tend to be very quick, they tend to be very defined. Generally speaking, debit spreads are a way that you can utilize these types of Bollinger Band retracement strategies, if you will, many times used by traders using technical analysis. So that is one of the few ways that you can use a moving average in your analysis and still have a good sense for the directional view. And lastly, I want to talk about these leading indicators. And I want to talk about this last because this is by far, I would say, the most popular use of buy and sell signals that people generate using technical analysis. If any of you use these types of indicators, feel free to type them into the chat window, which one you use, MACD, RSI, stochastics, and there are hundreds of these, right? William %R, commodity channel index, there are so many of them. But the one thing to remember is that they are all measuring the exact same thing, right? So, I see MACD, I see RSI, I see stochastics. So these are all the different indicators that you guys use. But the one thing that I want to remind everyone is that they measure the exact same thing. All of these ones that you guys all put into the chat window, they're all measuring momentum. That's it. They have different calculations and different mathematical formulas to try to measure momentum, but they're all measuring the same thing. The oscillators all, generally speaking, oscillate around a zero line. Some of them are a zero line, some of them are 50, and they range between, two ends of the extreme. So one of the things to really remember with these types of momentum indicators is that, number one, they all measure the same thing, which means that you don't need multiple ones. You don't need MACD and RSI and stochastics, because then you're just looking at three things measuring the same thing. And if anything, having three of them is just going to confuse you and provide false signals and provide you conflicting signals. It's far better off to use one and stick to one that you like or stick to one that you understand, because the performance of one indicator over the other is negligible. There isn't a huge difference between MACD signals versus RSI signals versus stochastic signals. They all have their pros and cons. No single one is better than the other one. So it's best that you stick to one that you like, that you understand, that you are comfortable using. And the second thing that's really important to understand, that I think most investors misuse these indicators, is that they are only telling you when momentum is reversing. So when you have, in this particular case, I have stochastics. As you can see, stochastics, the signal for stochastics is 80 on the sell side and 20 on the buy side. When it crosses above 20, that's a buy signal. When it crosses above 20, that's a buy signal. And vice versa, when it crosses below 80, that's a sell signal. Now, the thing about a momentum indicator is that when the momentum indicator generates a buy or sell signal, that is only telling you that the momentum has reversed, meaning it is no longer heading lower, it is now moving the opposite direction, or vice versa, it is no longer heading higher, it is now moving lower. But the momentum indicator in itself does not give you any sense for magnitude. So when you get a crossover on one of these indicators, the crossover itself does not tell you anything as far as how far the stock's going to go. It's only telling you that the stock is not going any higher. Vice versa, at the bottom here, it's not telling you how far the stock's going to go higher. It's only telling you that it's not going any lower. And those are two very, very different things to understand. So many times I tend to see investors use these buy and sell signals incorrectly. Meaning, when they see the buy signal, they go long the stock. When they see the sell signal, they go short the stock, expecting that the stock is going to make a sizable move in that direction. But that's not true at all. And if you look at the mathematical formulas of these things, you'll understand that it's only telling you that there's a reversal. It doesn't tell you anything as far as how far that reversal is going to go, which is why the only strategy that makes sense in this type of market environment is selling a credit spread. So when you get a reversal, that's telling you that this is not going to go any higher. So if you sell a credit spread that makes money, as long as it stays below that high, you're going to make money. When you have a reversal lower, what you want to do is you want to sell a put credit spread, and vice versa. Every time you get this sell signal, you want to sell a credit spread. And this allows you to profit as long as the reversal stays intact. And as you can see, all of these signals ended up making money if you sold a credit spread in these types of environments in this particular trade. If you tried to go buy a call or a put, I guarantee you not all of these trades would have worked out, because when you get a buy signal like this, you need a big move to the upside in order for a call option to work. If you get only a small move that moves more sideways, that call option is not going to work. And that's why it's so important to think about when you're trading these momentum indicators. Ask yourself, am I getting any sense for a magnitude? The answer is that the indicators themselves do not give you any sense for magnitude. You have to figure that out through other forms of analysis, perhaps through chart analysis, perhaps through support or resistance lines. Maybe on some of these occasions you are able to get a sense for magnitude, but most of the time you don't, which is why it doesn't make sense to use a debit spread or to buy a call or a put when you do get one of these reversals. So very, very important thing to remember and to utilize for your trading. So To wrap up what I wanted to show you here today, by far, the most important indicator that you're going to use in your technical analysis is price. Look at price first. Gain your directional view from that alone before you use any type of indicators, because any type of indicators should be there to help you confirm your directional views from the price. So price is always first. Indicators should be used to provide confirmation only. You should never generate your ideas off of an indicator alone, because an indicator can't account for so many different things that you as a human being can account for, like news, fundamentals, other things that are currently going on at the market. Those technical indicators don't have any of that information. So they're providing you a very limited view. Now, from my perspective, I've been doing this for 14 years and I've seen just about every single possible charting setup under the sun. I have seen people with very few indicators, and I have seen charts with hundreds of indicators on them. I will always tell investors that I tend to find that the fewer indicators, the better, because that avoids what we call analysis paralysis. I've seen many charts where people have 4, 5, 6 momentum indicators, and even though they're all measuring the same thing, they have different calculations. So some of them might tell you more neutral views, some might have more bullish views, and you get a very mixed picture. And many times that is actually very detrimental for traders. Traders need to be sure. Traders need to not have to sit in front of their screens thinking to themselves which way or another. They should be clear on their charts as to what the directional view. So fewer indicators helps you avoid being in that analysis paralysis state where you're not sure whether you should get into a trade or stay into a trade. You don't want to be in that state. You want to always be sure, even though at the end of the day, nothing is a crystal ball. Nothing will be able to tell you the future, but you do want to be able to have confidence in the directional views that you have. So in order to have that confidence, you need to understand your strategy fundamentally. So today's session was designed to give you a sense for the different types of indicators and what they actually provide you with. What type of information do they provide you with? What information do they provide you, and what information do they not provide you with? Because that's the type of information that you need to determine and audit your trades after the fact to see whether or not the trade worked out in your favor. And by far, the most important thing that I tell investors is not which indicators to use, because like I said, we've done these back testing on all of these different momentum indicators. It's not like one indicator really significantly outperforms the other ones where we can point you to and say, this one's the best one to use. They all have, generally speaking, the same characteristics. So instead of moving from the 20-day moving average today to the 50-day moving average tomorrow to the 200-day the next day, and then using MACD today and RSI tomorrow, what you want to do is you want to stick to the same strategy day in and day out. Choose a moving average that suits your time frame. Choose a momentum indicator that you understand and stick to that. That's how you're going to be able to gain that consistency and that confidence in your directional view if you're using the same indicators day in and day out the same way you would use it today, tomorrow, the next day. That's how successful traders manage to gain the confidence in their strategies. And then once you have that confidence in the directional view using technical analysis, that's when you want to lean on your option strategies. And you always want to select the optimal option strategy based on both the direction and magnitude. And I hope that today's illustrations that I provided you with enough examples to understand what I mean by understanding, do you have a directional view and do you have a clear sense for magnitude? Because some of them have a clear sense for magnitude, other ones don't, and it's important that you select an option strategy suitable for the outlook that you have. And it's really important to understand the relationship between risk reward and probability, because all of these trades that you're making is really a trade-off between risk reward and probability. And this is something that we discussed in our educational webinars on debit and credit spreads. So when you go back and watch those webinars, especially if debit and credit spreads are relatively new to you, watch those webinars, because we talk about the relationship between risk reward and probability. It's extremely important to understand that before you deploy these strategies. And lastly, I always encourage investors that when you're in the learning process and you're trying to figure out What is the best strategy? Options play really allows you to take the different views that you have. So let's say you have a view that Swedish match here is breaking out above that 700 level. You think it's going to continue moving higher. Do you want to buy a call option? Do you want to buy a debit spread? Or do you want to perhaps sell a credit spread? You can use the tools itself to select a strategy, compare them side by side, and actually see, using our P&L simulator, if Swedish match, which is trading at around 704, let's say it stays around 704, how much money do you make? Are you better off selling a credit spread, or are you better off buying a call or a debit spread? It depends on your magnitude outlook, right? So if I'm bullish on Swedish match, if I'm bullish by a little bit, then I'm better off selling that credit spread, right? And depending on which form of technical analysis I used, I might say I don't have a clear sense for magnitude. I'm going to sell a credit spread. And as you can see, as long as it stays above 704, 705, where it currently is, you'll make money. But if you bought a call or a put or a call vertical, you would have lost money. So you don't want to just based on your directional view, say, I'm going to buy a call, because that might end up losing you money. And this is a prime example of that. Only if you expect a big move, right, does it make sense for you to buy a call or a call spread. So that's when you go back to your technical analysis and you say, why did I determine I'm bullish on Swedish match? And based on that, that determines your outlook, your magnitude outlook. And that is how you select the optimal strategy. Because if, let's say, you sold a credit spread when you did expect a big and fast move, well, guess what? Here I would have made about 3,000 crowns in profit if I traded debit spread. Here I only make 970 crowns. So yes, both of these strategies made money, but one of them severely underperformed the other one. And arguably these two roughly have not a whole amount of difference in terms of risk. Here's 2,000, 3,000, 3,500, 3,000 crowns. So all of these are within the same realm in terms of risk. But as you can see, if I traded, a suboptimal strategy here, I'm looking at 970 crowns versus 3,800 crowns in profit. And that's why it's so important that you choose the option strategy that's most suitable for the outlook that you have on the underlying stock. So with that, that covers what I wanted to show with you here today. I hope that this was helpful in giving you a better understanding as to the different forms of technical analysis. But again, way more important than that is thinking through the thinking through the technical analysis and what option strategy suits it the best for the different outlooks that you have on that underlying stock. So with that, again, thank you so much for taking the time out here this evening to listen to me and teach you about technical analysis. Like I said, it's very near and dear to my heart, because I've been using technical analysis for the last 14 years in my career as a market strategist. And I think it's a very, very powerful tool, but I also know that there are many limitations to it, which is why it's so important for me to teach these limitations and show you how to go about thinking what is the best option strategy for the different outlooks. So with that, what I have is a few minutes to try to answer some questions. So if any of you have any questions, feel free to type them into the chat window or the Q&A window, and I'll answer your questions that I have a few minutes for here. So it looks like I would like to use IV rank. We will get it. So right now we don't have IV rank for the Nordic markets because I don't have a historical database of implied volatilities. We are in the process of building that right now, meaning we're actually collecting that information. But to use IV rank, you need a full year's worth of information. So we're still in the process of gathering this information. We don't have that calculation just yet. Any other questions regarding technical analysis or the option strategies that I went over here today? Are you using Fibonacci levels to determine magnitude? So I personally don't use Fibonacci levels. I tend to find that Fibonacci levels are so subjective because it really just depends on when you start drawing your lines. Just to give you an example here, I'll use the OMX S30 for example. So if we use the OMX S30, right? So my problem with Fibonacci lines is that they're so subjective. You can draw them, from sometimes people use body to body. So some people use wick to wick. Do you start up here? Do you start, where do you start? It's really difficult to determine, where your starting point is. Do you use body to body or wick to wick? It's just so subjective. And depending on how you choose it, you have different lines to draw. So that's why I generally don't use Fibonacci levels. I prefer to use technical indicators that does not rely on subjectivity, because a horizontal support or resistance lines, 3 people looking at the same chart would draw the same horizontal line, but 3 people drawing Fibonacci lines will draw very, very different Fibonacci lines. So that's, in my opinion, why I don't use Fibonacci levels. Can you give an example on technical analysis using momentum, volatility, and volume? Sure. Let's go back to Swedish match. So, if we look at Swedish match here, first of all, volume analysis is part of it, but it's not a huge part of my work. You do want to look at trends in volume, but single day volume, generally speaking, doesn't mean a whole lot. For example, here, Swedish match, notice how over the past couple of months, volume has started to decline. Those are some of the signs that, a trade like this is starting to get exhausted. So as you had the stock move higher and higher, notice how momentum did not confirm those moves high. They've actually started to move lower. You've had lower volume throughout this time. Now, that in itself doesn't mean that the stock's going to reverse lower. That just means that there is a higher chance that at some point you're going to get some kind of, more fast or violent pullback. But that's an example of how I would look at Swedish match, because as the Swedish match makes higher highs and reaches new all-time highs, momentum did not confirm that move higher. Volume is starting to decrease and get lower. So those are signs that it's starting to reach perhaps a market top. Now, that doesn't mean that Swedish match can't continue to trend like this for a while. It can do this for quite some time, for maybe even a few months before you actually get that correction. But those are some of the warning signs that this stock is starting to get exhausted. It is near a market top and is going to start reversing lower at some point. What about Ichimoku cloud? So, Ichimoku is also a popular indicator. Again, it's not one that I use very much. I do tend to find that some people really like that. And for people who really like Ichimoku cloud, I tend to find that people, it is very very objective as well. So I like it. Again, there are hundreds of indicators. This is by no means an exhaustive list of indicators. Ichimoku cloud is interesting because it provides both a directional view and sometimes a sense for magnitude. It really just depends on what type of signal you're actually generating from Ichimoku, because there are actually multiple types of signals that you can generate off of it. So from my perspective, it's less important which indicator you use. It's more important that you use the same ones consistently. So if you're using Ichimoku cloud, use it every single day. Use it on all your charts. Don't use it on some charts and not on other ones. Use the same ones on all the charts. That's how you're going to gain consistency in your trading. Any other questions about technical analysis? Is volume today affected by robot trading? There certainly is a larger and larger percentage of volume being traded through algorithms rather than human beings, and that is a concern, and that's part of why volume analysis, in itself on a single day is really not that useful. If you use volume analysis on a broader scale, it is generally speaking a little bit more useful, but volume is not as important today as it was back in the day, in my opinion. Thank you so much to everyone that said thank you. I appreciate it. Any other questions? If there are no other questions, I just want to remind everyone again, all of these resources are available to you free of charge at optionsplay.se. There's a wealth of information on options trading, on options strategies. I know many of you here are fairly experienced options traders, but I always tell users, even if you're experienced, you're always going to learn something new when you go through those education sessions. The courses that we have put together this year are really designed to help you better understand different beginner, intermediate, and advanced topics with options trading. So I highly recommend you to take a look at some of those sessions. So with that, again, thank you so much for taking the time out here during your evenings. I know this is still the summer months and many of you are still on vacation. So thank you so much for taking the time out here this evening. I'm really looking forward to starting back up in September with our normal coursework again on the options trading. So looking forward to doing that with you guys here starting in September. So I will send out the recording with the slides after we finish here today so that you'll be able to have this recording and review this at your own pace. So thank you so much. I hope you guys all have a great evening, and I'll see you guys here in about 2 weeks on the next session.